Hello and welcome to another episode of the Investing with IBD show. It's Justin Nielsen here, your host, and we're coming to you live at 5 p.m. Eastern as we typically do on Wednesdays. Today is July 16th, 2025, and we're really happy to have you here with us. And of course, we are also happy for all of you that do watch live and on YouTube and whatever platform you have. So we really appreciate if you give us a like, subscribe, all of those things. There's so much content that we have on our investors.com channel. So hope you enjoy that between the SMT videos and podcasts and everything that we do. A lot of education out there. And one of our favorite educators is coming back on the show today. In fact, there's already in the YouTube comments, I'm seeing some Don, like cheers here. So Don Vandenbord, of course, from Revere Asset Management out there in Florida. Yeah, we're going to really dive into how you get into a follow-through day, how you get invested, and it's great to have you on the show, Don, to walk us through it. Thanks for being here.
Great to be back, Justin. And this really has been almost a textbook follow-through day and post-follow-through day behavior in some leading stocks. So really happy to be able to walk the audience through the way we did things at Revere over the last almost 3 months now.
Yeah. And so what's great about this is it's almost like our own little post analysis of what you did because there, we like to look at things historically and see what we can learn from it. But this is an actual, we're calling it examples, but this is actually what you did. And it is a really good kind of textbook, as you said, this is how it's done. And now it played out one way. Of course, we didn't know that when the follow-through day happened on April 22nd of 2025 here. We didn't know how it was going to play out, but I think people will be able to hopefully see how you played it along the way to say, okay, well, if it does this, then we got to back away. And hopefully seeing that in real time will be something very helpful for folks.
Yeah, I was on IBD Live on 5/16. That was only 3 weeks into the rally, and at that point, you're still looking for some of the landmarks to determine is this going to be a rally that I'm, to look at Eric Kroll's definition, and he does a fantastic job qualifying all these types of rallies. I really enjoyed his IBD Live show last Friday. But yeah, you're still trying to figure out, you've got the early leaders. Are they going to be leaders that are going to fade? Are new names going to come to the fore? There's so many pieces to the puzzle that it's just so much fun to put together every day.
Yeah, very good. Well, let's get right into it. And just a warning for those of you that are listening to this, we might be a little chart heavy on this one. There's a lot of spreadsheets, and again, I love a spreadsheet more than anybody, I think, and really appreciate how you kind of use your spreadsheets, Don, to really kind of lay things out, and it in some ways just makes things clear cut, because Excel doesn't really accept iffy, right? It's like it's either it is or it isn't. It doesn't say like, oh well, in this case, unless you add that in, it really is kind of
Yeah, it's not quantum computing. It's either ones or zeros.
yes, right. Yeah, it's
Where
not
we
this
are right
range of
now.
possibilities or the fuzzy math, and of course you've got an engineering background, so or computer programming and all of that, so you
Right.
are very well aware of that. But yeah, it does make it very rules based, which is something we really appreciate here. But let's get right into it. I'm going to pull up some of the screens, some of the slides that you shared with us, and this is called writing the FTD wave follow through day. FTD standing for that, and how you kind of construct your portfolio. So walk us through kind of, again, you're a lot of times in when a follow through day happens, especially after a bear market. And look, by all stretches of the imagination, we did suffer a bear market here. We got a 20% correction. It was sharp, it was quick, it didn't last very long, but it ticked off a lot of the boxes. So how do you go from kind of a big cash position to, oh, when do I start dipping my toe in?
Yeah, that at the end, like the last slide is going to show a bunch of trades that were made overlaid with the action on the S&P 500. But first, these first couple slides, we'll just talk about the tactics, the rules and tools that we use to manage portfolios. Our flagship portfolio is named Grotection. We're a registered investment advisor. We're not a hedge fund, so everybody has a separate account that we manage. That doesn't mean we have to go into everybody's account and make a trade. There's something called block trades
Hmm.
where if we have to buy 3% of Apple, we just know based on our AUM what 3% is. We buy that number of shares, and then they get allocated to everybody's account depending on the size of the account. But it starts with the M in market, and the tool that we use there is a trend gauge, which tracks three things: the major indexes over three time frames, and it tracks the action of leading stocks. So that's one of the major tools that we use, and you're going to be all red. It's a red, yellow, green kind of simplified version of what's going on with the trend. We started at the bottom with all red, and we've worked over the last 3 months to all green arrows, and then breaking that gauge down, the different signposts that we're looking for. There were 10 steps. I think I showed this chart when we were on IBD Live, but we've checked off quite a few more of the steps, so we can take a look at that. And then if I like anything more than a spreadsheet, it's a good acronym. And I'm going to 4 tools that we use in-house: RVAB, volatility adjusted beta. This is a calculation that we use for every stock or ETF that we own, and it combines the beta and the ATR and compares it to the S&P 500, and it gives every ticker a score. And then if you often hear about people saying, well, I think I need a slow stock for my portfolio, or I think I need a fast stock for my portfolio. Well, we solve that by RPRP, which is positional risk parity, and it's position sizing so that you vary the size depending on the volatility adjusted beta for each position. So that way, if you're putting on a full position in Hood, it might be 4%, whereas a full position in Netflix might be 11%. But
Right.
based on the way they act and their average true range, this kind of smooths the risk across positions. And then knowing how much progress you're making, when do I start to put the pedal down? What if my first 3 buys didn't work? Well, what if you had picked those 3 out of 12 and the other 9 did work and you just got unlucky? That's why we create 2 lists in all of our videos that we discuss. There's a 21 over 21 leaders list and a Turbo 12. That's Turbo Protection is our more aggressive portfolio. It has smaller names in, more crypto, but REBAR, estimated balance at risk. You want to make sure that you're making progress in your account as you're putting more risk on, and always knowing that if all of your stops got hit, how much would
Yeah.
you lose? So that's something that we're happy to be able to give to our clients at any point in time.
Yeah.
And then,
And I just want to stop you real quick because
okay,
why that's important, at least to me, is sometimes you have to do a little soul searching in terms of if you start seeing, or you can be surprised because a lot of times when stops hit, they do it all at once, right? So
right.
you might be thinking, okay, this is a worst case scenario, but you'd be surprised how many times. I mean, even look at today. We had news out about, Jerome Powell, and man, it was not stops for me, but a lot of alerts that I had were just getting triggered one after another, and having that kind of how far out there am I? What kind of um,
How much
you know
pain am I going to
yeah, how
handle?
much pain could
Yeah.
I be in for? Preparing yourself for that, or looking at that number and saying, no, I don't want to do that. That would devastate me to have that kind of drawdown. I think it's a very useful thing because again, risk management so important, and um, having that drawn out ahead of time and
Exact. That's
thought through.
exact. Yeah, that's exactly the point. When you're getting a bunch of alerts like that, knowing that you've already planned ahead of time. Well, I know if they get hit, here's what my pain is going to be, and I've accepted that going into the trading day. So it minimizes panic
Yeah.
certainly, and everything that we've done at Revere is designed to create a smooth equity curve, remove emotions from the equation, and just let what's actually happening in the market take over.
Yeah, no, absolutely. It goes back to for those that watched, I think on your last show that you were on the podcast, we talked a lot about that move from, if you're starting from San Diego and you're trying to get to Maine, how how do you do it? How
Right.
how much of a direct path do you take, or how do you avoid going to Florida? Nothing
Exactly.
against Florida, but
Florida would be a problem if you're trying to get to Maine. That's absolutely true.
right. So, okay, go ahead and continue. After estimated balance at risk, you've got your index positioning, and then
Yeah, we're very strong proponents of having an index position as a core part of the portfolio, and that's because on those days, and we've all experienced them. There've been really three over the last 2 weeks when all the leading stocks get hit. Really, what's happening is if you take a look at the RSP and the S&P 500, money wasn't leaving the market; it was just flowing from one sector to another. So every point lost in technology was a point gained by financials or
right.
medical or industrials. And that RAIR is aggressive index reentry. This is something that we came up with after the 2022 bear market to uh, get back into the market quicker while you're not necessarily sure what the indexes are going to be.
Hmm.
Because if you're struggling as a trader and even managing money, the question we get is, what's the S&P 500 doing and how are you doing against that? Well, we're going to be out of the market when the market uh, is ugly below the 200-day moving average, but we've got to have plans to get back in because if the market takes off higher to the upside without you and leading stocks aren't set up, you can at least take advantage of that index gains. It doesn't matter how you get your gains, unless you've got an ego problem and you don't say, I don't want to be in the boring indexes. Well, do you want to be cool or do you want to make money? And
Right.
we can certainly make money in the indexes when they're going higher as well.
I mean, it's certainly fun to have all the hot stuff when you're at a cocktail party, but at the end of the day, um, you know, how much money are you making? Because you can have small positions in a lot of the hot stuff, and it's like, oh, is that even moving the needle for you? But you can say that you own it. Getting back to your ego part, but let's go ahead and move on to the stock selection because again, I like to sometimes start with the indexes. Either I think this time I was actually a little bit more tentative. I was doing more QQQ and SPY before I kind of ramped up to the TQQQ
Yep.
and UPRO. Actually, I was just more TQQQ this time around, but eventually I start looking a little bit more at the individual stocks. So, how do you go about doing your stock selection?
Well, what we're looking for in an uptrend, and I've got a chart the next to the last slide. We'll see it. We have a strategy called the EZ8E, and the strongest stocks you will notice they trend up along the 8-day exponential moving average. Some people use the 10 simple. They're very similar. These are the names that we're looking for. It does no good to buy a slow name if you don't just want to get the S&P 500 return because growth stocks should return 2 to 3 times. So that's absolutely what we're looking for in our names. We want those names that when the market's going higher, they're riding the 8 EMA higher. They're showing much stronger gains than the overall indexes are. But that part of the index can also be in SSO or SPXL or UPRO, which are ETFs that return 3 times. So I would rather buy one of those than buy a stock that I hear the term Chris Gessel uses all the time. This is a market stock. You don't want those in your portfolio.
Hmm.
There's no reason to take a market stock when you're getting individual stock risk. You might as well be in the index taking that risk and having it being spread among 500 stocks and
Yeah.
getting the same return. So that's why the relative strength line is so important on every chart. You really
Hmm.
want those things where the relative strength line is trending higher.
Hmm. Now, when something breaks that trend, a lot of times it's very temporary. So,
Right.
how much room do you give it?
We give it 2 to 3%, and it's dictated by the ATR of the individual name. So,
Hmm.
you absolutely do see that all the time. You see intraday, it'll tuck below the 8 EMA, but end up closing back above it. So, we found that given that 2 to 3% below the 8 is enough room to keep you in it, along with the proper sizing. If you've got a 15% position and you're down 7% on the day and it breaks the 8, you're going to be tempted to get rid of some of that. I'd rather have the 4% position and know I'm giving it a little bit more room and smooth the equity curve intraday and long term.
Yeah, absolutely. So to kind of break this down on the stock selection side, of course, there's the buy rules and the sell rules. So Can you walk us through a little bit of both to kind of
Yeah,
determine how that
most
happens?
of our buys and sells fall into these categories that I have there: volume gaps, whether it's on earnings or a news catalyst, or volume breakouts from sound bases.
Hmm.
And then those are the ones where we take our initial position, whether it be a third size, a half size. But then we look to add to that. If you can't get your full position on right away, we look to add on strength after weakness, so post weakness.
Hmm.
And a tactic that we use all the time is a pullback on the to the 8-day EMA. And again, the 8 EMA should be, if the stock's going to keep going, that should provide the support that you're looking for. And if you
Hmm.
combine that with the stochastic data that you get in Market Surge, you'll see a 60-minute stochastic cross, and it's a great low risk entry because if it works, you've got great. It should, because if the market's strong and the stock's strong, you should continue to ride the 8 EMA higher. If it doesn't work, that's maybe telling you something about the individual stock, or maybe the market is weakening.
Right.
And in addition to those pullbacks, the traditional pullbacks to the 21, the 10-week moving average, and the 50 or the simple 50 simple moving average those are just classic ads.
Hmm. And then on the
So
sell side?
yeah, on the sell side, offensive selling is critical. I think that one of the mistakes that newer traders make is they think that every stock that they buy is going to be the next big thing. It's going to keep up going forever. They never take profits on the way up, and then when you get hit with one of those days where all leading growth names get hit, you give
Right.
back all the gains that you made over the last couple of weeks in one day. But taking some off on the way up, and we like to use an ATR extensions from the 21-day moving average. And usually when we're doing this, we're looking, and it's no guarantees, of course, there are no guarantees in the market, but really what we're looking for is to add that position back and maybe a little bit more when it retraces back from this extremely extended condition. So it's
Hmm.
really a temporary thing. You don't know if you probably didn't get the top, but if you did, at least you locked in some gains. And if
Right.
not, then you can look to regroup when it pulls back.
You
So
know,
that's
a quick
that,
question on this because,
sure.
okay, on the ATR extension. So when you initiate your position, the ATR might be one thing, right? And then as it goes up, maybe you have some, a larger ATR, or it could be vice versa. It might have had a lot of volatility right before the breakout, and then a little bit less, and so the ATR kind of goes down. Do you Are you constantly adjusting, like, oh, this is what the ATR is now, or this is what the ATR was at the beginning, and I'm going to use the extension from that kind of snapshot in time?
No, we adjust it twice a week. So
Twice a week, okay.
yeah, we adjust the ATR of the S&P 500 and then the ATR of the individual names. And we use the 21-day data that Market Surge provides, both for the S&P and for the individual names. Good question.
Yeah, perfect. And then, does that kind of wrap up this slide?
The defensive sell
Oh,
signal.
yes.
The initial purchase, we're targeting 0.20% of the total portfolio as our stop. So we kind of back into our position size that way. And if that stop gets hit, it gets hit. I mean, we got hit today on Uber. Just didn't work. The market's fine. Uber broke the 21 and triggered our stop. So out of the portfolio it goes. And then we raise our stops based on the trailing break of the 8 and the 21. As they make progress, we move the stops up, obviously. But the fact that it should hold that 21 gives us the confidence to move that stop up very frequently as the 21 and the 8 work
Right.
their way higher. So the
Hmm.
initial position is very frequently against the 8 EMA. How much can I squeeze in? And only lose 0.2% of the total portfolio if I'm wrong. And then if it starts working, you can pyramid and move your stop up at the same time. And then the 21 gets above your cost. You can use the 21 as a stop for a portion of it because you're making progress in your portfolio. And then the same thing with the 10-week. Palantir, a leader, just touched the 10-week last week, I believe, and buyers came in where we wanted them to right there.
Hmm. Now, are you, with some of these stops or crosses below these moving average lines, are you doing this at the close? I mean, sometimes you can have it like today. I mean, you had some ugliness today, and then a lot of things reversed as kind of the news changed. President Trump came out and said, "Oh yeah, I'm not firing Powell," and markets, turned around. You saw a lot of reversals. If you had sold at the lows, you would have been like, "Oh darn, I got shaken out." So when these triggers happen, do you give them time, or is it like, nope, this is my level, and that's it?
Yes. So if we're using the 8, then we normally have an alert at the 8, but the actual stop is 2 to 3% below the 8. So we'll get the alert. That doesn't mean sell immediately. It means monitor it for the rest of the day. Keep an eye on it. Definitely try to give stocks the benefit of the doubt in a bull market, unless they're just showing terrible action, and then you absolutely have to obey your stops intraday if they get hit. But knowing that the alert happens at the moving average, you see the undercut of the moving average frequently. But how far is it going to undercut before buyers come in? Or is the market rolling over because of some kind of a headline or something changed? There's plenty of headlines in this type of
Right.
market to both to the upside and the downside.
Yeah.
We certainly know
Yeah.
that from the last 3 months.
And sometimes, counter headlines within
Right.
within minutes,
Yeah.
like today. So to shift gears a little bit, okay, so that I feel like those, that gives us the framework that you're dealing with. So let's kind of get into a little bit more of how this plays out in real time. So first of all, I mean, I think this slide that you shared on, I believe you shared this on IBD Live, kind of interesting about, you know, kind of knowing your history to a degree.
Yeah, these are the portfolio killers. And our system is designed to get out within 10% of the high water mark of the portfolio. And normally that coincides with a break below the 200-day moving average, and then we give it some wiggle room below the 200-day. But losing 10% instead of losing 21, and those are the mild bear markets,
Right.
like the one that we just saw. So this is the setup where we were February to April 2025. Late April, we had the back-to-back follow-through days, and that's what kicked off this latest run to the upside. But knowing how much you can save below the key levels,
Hmm.
all of this pain below normally 10 to 12%. This additional pain you can save yourself if you just obey a couple of rules,
Yeah,
which
it's
we
like,
talk about all the time.
yeah, once you figure out that, oh yeah, that's hot, if you can take your hand off of it, you can, get a first degree burn as opposed to a third degree burn. Is the way I
Yeah,
look at it.
and
Uh,
those severe bear markets on there, the average is 44%. They all started as a 12% pullback, and then
Absolutely, yeah.
15, and then 20, and then it kept going. And
Hmm.
that's where knowing where the risk picks up. We like to say we're experts at determining the difference between a healthy market and a risky market, and
Hmm.
that's what we discuss on our nightly videos all the time.
Yeah. Now, to kind of just go back to the market trend, and your grotection gauge, one of the things I wanted to ask you about is, okay, I mean, the short term, medium term, long term versus the 21 EMA, 50 SMA, and 200 SMA. That seems easy enough. It's, again, it is or it isn't. But what about the market leaders? How do you determine that? Because that seems
Yeah,
a little bit more subjective as opposed to objective.
it's by keeping the leaders list. We're monitoring. We're big. I mean, the 21-day moving average, as Mike says so many times, good things happen above the 21, bad things below. That's kind of the baseline for what we want our leaders to be doing. And if you're putting a list together of what survived in a bear market above the 21, and it's all staples and utilities, then you kind of know you're not in a healthy growth environment. But there are always things that stand out as the market's trying to put in a bottom. The two that came to mind for me were Palantir and Netflix were two that absolutely held up. So it's a matter of building your watch list constantly. And then once the market rally gets underway, monitoring what's happening with those leaders. So you don't want to just key on the two or three that you bought. What about the 21 that are in your total leaders list? How are they working? We had a day last week where all 21 of our 21 over 21 list was lower. That had never happened before. And then our turbo list, all 12 of those were lower. So that's telling you something about market leadership at that point in time. And then you're looking for follow-up. Are they going to keep selling off? Because there was a brutal 3-day sell-off that kicked off the last bear market. And you're absolutely right that that's a little more subjective. But that, and we also created something called the RG8, that's 8 growth ETFs, and we monitor the charts of those. And FFTY, the IBD 50, is one of those 8. And that gives you a good feel for what's happening in overall market leadership.
And is it the S&P 500 that you're
It's the growth half of the S&P 500, the growth
okay.
half of the mid cap, the growth half of the Russell 2000, SPHB, ARK-K. They're growthy type ETFs, and those charts should be acting well if growth leaders are acting well, and that's what gives us the signal along with the indexes to move into those individual names.
Well, I'm just going to pull up. SPY real quick because some of the areas where you were showing how things had turned to those red arrows. Starting kind of in the end of February here. So just so people understand where this was happening. So February 27th was one of them, and then you had March 27th and 28th. And people might say, "Oh well, gosh, isn't that late? It's all the way down there." But man, if you cut off this part right here, that's
Exactly.
that's helping a lot. And
That's exactly the point. Yeah.
yeah, and I mean, look, people can say, "Oh well, if you had gotten out, you would have missed that April 9th day," but I'm okay missing April 9th if I miss this too, because that's what scares me is this kind of stuff. That's where I lose my nerve. So if I'm going to lose my nerve, I might as well lose it early. you know?
Yeah, and that big red light starts flashing once you break that black line there, the 200-day moving average. Every single bear market occurs under that level. And it's normally a 3 to 4% envelope where if you're going to come back from it, that's where it's going to happen within those percentages. But once you break below there, the odds are you're going lower. So this is the trend gauge now. So over the last 3 months, you can see the dates where we pretty early, 425, moved our leaders to growth, moved our short term to growth, and then 3 weeks later, medium term moved up, and the stubborn small caps were the last holdout on long term. We were on neutral for a while there, but finally they cleared the 200-day moving average, and then on 7-3 we moved the long term to green. Those yellow caution right there, we put those on in 7-3 because we got historically extended from the 21-day and the 50-day moving average on the S&P and the NASDAQ 100. That's something that we monitor close, and that's basically saying, yeah, the market's green, but we're a little bit too extended. If you start piling in now, you're setting yourself up for some heartbreak because the odds are you're going to get a pullback. What we want to get is a pullback through time and not price, and that's actually what we've gotten over the last 2 weeks. Is we've gone sideways while we let the 21-day and the 50-day catch up to the indexes.
Yeah, so I'm showing the S&P 500 right now with that July 3rd, and yeah, just as you said, the market didn't even come down to the 21-day moving average line. It just kind of has been going sideways. And look, some of these days haven't been pleasant. I mean, yesterday I was having a great day until I wasn't. Like I ended up down for the day, but after having a really sizable gain. But yeah, nothing. So how long does it kind of take for this to let you know, oh, this is consolidating through time, not a big issue versus, oh, I might have to take some off here.
Yeah, we took off the caution today, actually, in tonight's video for the 21-day because we came close enough to it that we're not historically extended anymore. But when we get under 4% on the 50-day, we'll take that off. And then if the Qs get under 5%, we'll take it off as well. So, being 7% extended is just too far. You could keep going higher. There are no absolutes in the market, but the odds are you're going to pull back. You could pull back in a harsh manner, or luckily you could go sideways, which is what we've been seeing.
And then this is so important. I think if we go to the next slide here, what a lot of people have to realize is, the way that you get in, it's not just putting all your chips in on day one. There's all of these kind of thresholds that you look for and say, okay, are we really in a strong market, and getting that incremental. So here's your 10 steps from bottom to bull.
Yeah, this is basically the S&P 500 and what the action is against there. In order to stop going down, you're going to have to regain the 8 EMA. And at the bottom, all of the moving averages are exactly opposite of what you want them to be. You want the 8 above the 21, above the 50, above the 200. You'll get the opposite as you're in a severe bear sell-off. So little by little, we want to start regaining those moving averages. Look for the follow-through day, which we got there, and then no distribution after the follow-through day. And then just exercise a little bit of patience while the shorter-term moving averages cross up through the longer term. Or if they don't happen, then that's telling you something about the market. But the last one of these checked off on 7/1 when the 50-day crossed up through the 200-day on the S&P, and that certainly took a while. You can see that was almost 2 months after the step 9 checked off.
Mm-hmm. Yeah. And, I think we've gone through some of your spreadsheets before on the podcast, and you've also shared them, and gone through them on IBD Live. So just kind of hitting some of the broad strokes here in terms of how you set this up. I mean, this is an example with your RVAB and how NVIDIA, and it's just kind of a simple matter of formulas, right? Here's the inputs, here's the outputs, and
Yep.
let Excel do its work.
Yeah, it's not as daunting as it looks. You just need 3 numbers. What's the S&P doing on an ATR basis, and then whatever ticker I'm considering, what is its beta value and what is its ATR, and just then compare those to the S&P 500, and that volatility will give you a score. The higher the score, the more volatile the name. So then you want to position size it lower. And this is a sample portfolio. This isn't current right now. But then you add up all the scores of the individual holdings, and that gives you your score for the overall portfolio. With a portfolio that's 100% in the S&P is equal to a 1.0. So if you're above 1.0, you're taking on more risk than the S&P. If you're below 1.0, less risk than the S&P.
Mm-hmm. And again, we're not in this to match the S&P 500, right?
Right.
Otherwise, why not just buy the index and call it a day and sip your Mai Tais? We're trying to get even a little bit of outperformance each year can really kind of compound out to something spectacular. So kind of walk us through this slide a little bit.
Yeah, this is a sample portfolio, and it's just the size of the individual names. Very similar to the prior slide before, but this shows the ETFs at the top, the individual names at the bottom, their volatility score and their size. That gives you the RVAB, and then those summed up equal the red highlighted number of the value of the portfolio. So this would be a portfolio that's 21% more risky than the S&P.
Mm-hmm. Yeah. Simple enough. Again, once you have the spreadsheet set up, I'm sure it takes some work to do that, but again, then you let Excel do the work for you. And then here,
and
it
speaking
looks
of
like
Excel,
got kind of everything sorted by your volatility. So okay, there's a difference between your Sezzle and your Microsoft, right?
exactly. And also not only that, but the individual stocks have their own score, but then how many do you want to have in your portfolio? How big a position size? There are people that take on a lot more risk than I do. If you only want to have 4 to 6 names, you can position size quite a bit bigger than if I'm really in the 7 to 10, 6 to 9 names. So between 0.15 and 0.175 for each individual holding. And this graph just tells you, find your ticker, find its volatility factor. There's your full position size if they're going to be equated across all of them. And the beauty of that is that you don't have to say to yourself, well, I need a stock that it moves slower to balance out the rest of them. This gives you the exact size that you would need to equate the volatility on each individual name.
Yeah, and again, it when you have your rules kind of already established, it kind of makes it easy to see this in Excel. Is okay, how am I going to construct my portfolio based on those rules? And
Right, and
this
then
one,
yeah,
go
go ahead.
ahead.
Sorry.
No, I was just going to ask, explain this one, and you
Yeah,
were just about to.
once it's constructive and you start buying, then the question is, where are my stops and how much progress am I making? And the table on the left is each individual name. This is actually the current portfolio that we have. The size of the individual names, the stops for the individual names, and add it all up together gives you the score in red, which is our estimated balance at risk. So if all of our stops would get hit, the portfolio would have a 5.08% drawdown from where it currently is. And then these scores, every day we update this, the table on the right, you want to start seeing that you're making progress and that your floor is being raised, because it does no good to gain 10% and give the entire 10% back. So knowing that, yes, my floor is going up, those are basically gains that are locked in during this rally. So as of yesterday, a 14% gain, our balance at risk was 5.5. If we get stopped on everything, we know during this rally that we still made 8.49% on the portfolio. And if we made that and we turn and go into a bear, then we're starting from a much higher capital level to compound off of, and that's when the power of compounding can really kick in for you.
Yeah, no, absolutely. And then, of course, just to kind of sum up your rules,
Yeah,
you
this is one of the newer ones, re-entering off of the bottom, and I talked about the core S&P 500, and we use non-leveraged for that. So basically, 30% of the portfolio is in SPLG. That can be hedged if you start breaking the 200-day moving average, but there's also a tax implication of this. Getting stopped out on the individual names is one thing. You don't want to sell everything out and have to have massive capital gains. So the 30% core position combined with being able to hedge them gives some cost certainty and also some tax certainty. About 75% of our accounts are retirement accounts, but those 25% larger accounts that are taxable, nobody likes an unnecessary tax hit.
right. Yeah. And then also just another element here is your grow rules.
Right. So as of yesterday, that first line there, this is me saying you got to be in the market regardless of what the headlines are, from a minimum on the S&P 500 using the 30% single, and then the rest are SSO, which is a double, and U Pro or SPXL, which are triples. But the first line there above the 21, we wanted a 70% minimum in the S&P, and we'd had that for weeks. Asterisk 60% if O trimming due to being extended, and that failed breakout yesterday did trigger that, so we took a little bit of that off, got it back down to 60%, and now we'll watch to see if we can get a low risk re-entry to add that back and some more. Same thing we're looking at with individual names, but this is key when you're managing large amounts of money, to be able to stay in sync with the market and not get overly bearish. Because one of the problems I had early after I experienced, you actually have sell rules, is overusing them.
Yeah.
I'm not a naturally aggressive person by nature, so for me, it wasn't keeping me out of the market. It was keeping me in the market. When you can get tied up in the headlines and your thoughts, everybody's got emotions, but these are rules to keep you in as much as they are to keep you out when things start to break down.
Mm-hmm. No, absolutely. So you mentioned individual stocks. Let's kind of shift, for the rest of the show to really kind of show how this happened, and how, what you did with individual stocks. So here's Robinhood that we'll look at, and I do have a position in this, probably not nearly as good of a position as you have. This was a more recent buy for me, just because I couldn't stand looking at it going up every day without me. So it's a smaller position for me. But
Well,
what do you how do you handle individual stocks?
so the point with this one is it's that 8 EMA rule that I mentioned. You can see how the majority of the action from that gap up, the stock tends to ride the 8-day exponential moving average higher. Sometimes it gets extremely extended. So a couple times along the way, we've taken offensive profits, offensive selling, and then on that most recent pullback to the 8, we used that 60 stochastic rule to reestablish a part of the position. And as long as that continues to work, we'll continue doing it. If it would have broke that, we'd have been stopped on that existing position, and then we would look to where are our stops on the core position that we're holding. But the point of this, and there's a lot of names like this, you can see how it rides that 8 EMA higher with those intraday pullbacks, and that's what that 2 to 3% overshoot is designed to catch. But I mean, this hasn't touched the 21 the entire time, so this is like the poster child for what you want your stock to act like in a strong uptrend.
Right, exactly. And again, I appreciate so much how much you're sharing here. And so again, for those that are listening, if nothing else, come into this part right here to see this chart that Don prepared, because it really kind of shows how this all comes together. So walk us through what we're looking for. And again, I appreciate how much thought you put into exactly lining things up here. This is
Uh,
awesome.
sure, I know it's kind of small, but the chart at the bottom that goes week by week through what our adjusted beta exposure to the market is. Now I know a lot of people like to talk how much cash do you have, but that's not really the way we do things. That's not the right question to ask, because take a look at the first set of data there. Our adjusted beta was 0.1. That's the equivalent of being in 10% of the S&P. That was 20% in SPLG and 10% in SH hedged and 70% cash. So I would say I was 70% in cash, but really I was only 0.10
Yeah.
in the market. So then as things start to progress, I tracked the adjusted beta of the portfolio week by week, and then to the bottom compared what the cash levels were for those different adjusted beta, remembering that a 1.00 is the equivalent of being 100% invested in the S&P 500, like the SPY or the SPLG or VU or IVV. And then the boxes on the top were when we took individual buys and or sells on the different names that were in the portfolio. Some didn't work. We got stopped out on. One shook me out horribly, and I didn't get to capture the gains on Credo, CRDO. That's probably the biggest regret that I have during this period. But applying the rules has worked, and we've chalked up some decent gains over the last almost 3 months now, and raising our stops. We know that those gains will be locked in. We know what our what our downside is, and we know what our risk is on every day. And this is what allows our clients to sleep well at night, knowing that their downside's protected like this. And all my money's in the same strategy as theirs is, so I want to be able to sleep well at night as well. And
Yeah.
and these are all, Bill O'Neill started the whole thing writing the book and starting IBD, and the rules are timeless. They've adjusted because of different market conditions like Reg FD over the years. Things have changed, but the laws of supply and demand and fear and greed and market behavior are still consistent.
Well, I'm glad you brought up Reg FD. So that's of course, I think that was what, 2000 where that came out, regulation, fair disclosure, and it has added an element to the earnings announcements, right? There's no more
Right.
wink, wink. This is what the earnings are going to be. So sometimes it's a surprise to everybody, big reaction, and of course, uh, you can have a stop in place, but if a stock gaps down below it, you might not get that stop. So, do you adjust anything? We've got earnings season coming up. 160 S&P 500 stocks in the 2 weeks,
Yeah,
how do you make adjustments for that,
that
knowing that it's a risk event that you can't necessarily get out at your ideal stop?
that's a great question, and we use a tool on Thinkorswim, the market maker move for each stock. So going into earnings, every stock they give a plus or minus number of dollars up or down. We convert that to a percent, and that's no guarantee that they're only going to go down that percent. At the worst case, we've seen multiple blow ups. So we surprised Justin have a spreadsheet for it, and the maximum that we want to lose is 1% of the overall portfolio on an earnings blow up. So we take a look at what the market maker move is to the downside and multiply it by 2. So we're assuming a worst case 2 times the market maker move to the downside. How much of a size can we have in that name if that worst case hits, to make sure that we only lose 1%, and then we just size it down to match that, to make sure that that's that size correctly going in. So we're not that we have to have 10%, we have to have 5%. We know what we want to lose, worst case. And if you like a stock and you're up 7%, well, that's not 10%. Why should you cut it? Let it ride. Define your risk using that formula, and see how the market reacts to the earnings report.
One of our watchers on YouTube here wanted to kind of ask a little bit of a clarification. So when you've got your calculated stop, if that's lower than like the ATR, is that just an adjustment you make based on position size to kind of deal with that, or?
Yeah, if the stop gets below where the ATR is, it's because the stock has been pulling back. So yeah, we're not going to give it a full ATR the next day. Where there's certain levels where we expect buyers to come in, and if they do, great, and if they don't, we'll get stopped. So we
Okay,
don't
so
go in
last
every day.
question.
Yeah.
Last question here. So, okay, we've kind of walked through how you did this, and again, for folks that are looking at the chart, study this a little bit, because it does show week by week, and it's staggered. So here's April 18th. Here's the week after that, May 2nd, the week after that. So it shows how exactly you were getting in. Now, when do you start saying, okay, this has gone up long enough? Is it just using those extension rules? Do you start when do you start getting a little nervous that you're closer to the end of the game and you need to adjust?
We the only thing that how many times have you heard people say this rally is long in the tooth, and then we ended up being a
Can't
2 year
go up much
rally?
from here.
Yeah, the only thing that has throttled us personally over the last 2 weeks was that how extended we were from the 21 and the 50 on the S&P 500 and the Nasdaq, and we kind of put the brakes on. We didn't stop doing new buys, but they were prudent. They were smaller. Crypto stocks right now don't care how extended the S&P 500 is from its moving averages, but so you can see we've kind of gone sideways over the last almost 3-4 weeks in our adjusted beta. It's been around that 1.35 ish.
Yeah.
And that's a combination of it's a combination of setups, low risk setups, and a combination of after we got those, you can see those 7 days up when we hit that extended, that we put that extended level 2 weeks ago, that we put that yellow caution on the trend gauge, and that's kind of kept our buys tempered over the last 2 weeks. One thing I want to note on here, and for sells, an X is we closed it out, like find a box where there's an X, like in that box to the
CrowdStrike right here.
So
Yeah.
if that means we got stopped. If we trimmed, it had an offensive trim is minus and then an O. So that means we reduced the position and it was an offensive sell. So HIMS, GEV, and Hood, you can see those were scattered there like that. A plus means we added to the position. We already had a position and we added to it.
A minus, I assume.
Yeah, minus is trimming. Yep.
Yeah.
Yep.
What about double plus?
Double plus means we did 2 buys that week on Uber,
Okay.
and then today we got stopped on both of them. It just didn't work. They
Mm-hmm.
don't all work.
And then the next kind of thing to be watching for, sometimes you do get some sector rotation, as you mentioned, like RSP, was doing well one day, and tech was getting hit. How much adjustment do you make? A lot of times that sector rotation can happen in things where the relative strength isn't as strong because they haven't been participating.
Yep.
So how much leeway do you give something that doesn't have the great relative strength, but there's a sector rotation going on?
We won't. A good example for that would be ITB. The home builders had been torn apart. They had, over the last 2 weeks, a big move up. They gave the entire move back yesterday. We just stayed away from the sector because they're below the 200-day moving average. If we were going to buy it, we probably would have used Nail
Mm-hmm.
as a leveraged ETF. But damage charts, there will be time to get into it if it's going to make a significant move. This just isn't going to go up 10% and then stop. So we'll watch usually you really don't, in the home builders case, have a standout right now. Usually there's a bunch of laggards and 1 or 2 leaders, but they're all under the 200-day moving average. But we'll catch that sector rotation by being in the value half of the S&P 500, and if some of those names clear their 200-day, set up nice bases, and then break out, then we'll get in the individual names when their charts repair a little bit more. But
Mm-hmm.
we don't buy relative laggards until
Mm-hmm.
they set up in some sort of a sound base, some sort of a reasonable buy point.
Yeah, it's a strong reminder that you have time. If there is going to be that turnaround, you have a lot of time to let it kind of mature before you try and get in at the bottom. Everyone wants to get in at the bottom, of course, but
Only one person gets in at the bottom, Justin, and only one person gets out at the top. And
right.
it's probably not either of us, right?
No. Well, I think I've gotten out at the bottom before,
Yeah,
not in at the bottom.
that's
So I've been that one person that got out at the bottom. Don, it's always a pleasure chatting with you. I really appreciate how much you shared. Again, this is one of those where I think people really need to kind of study that chart a lot, because it really lays out. You had your rules, you implemented your rules, and it's been working out. So that's great. Thanks a lot for sharing so
I
much
appreciate it
of
so
what you
much. I
do.
mean, I've learned so much from you guys. I mean, this all started with going to a level 1, 15 years ago, and here we are now. So
That, that's
just
awesome. Well,
just built
glad
on
to,
it
glad to
day by
have
day.
you as part of our podcast team, as a recurring guest, because it's really great. I love how you look at stuff. So thanks again for coming on.
Appreciate it very much. Thanks.
Okay, that's going to wrap it up for us this week. Thank you so much for watching. Tune in next week, because we're going to have Jason Shapiro, one of the market wizards, back on the show. So it's going to be great to talk to him and kind of get his take on the crowded areas of the futures market. So tune in for that. We're going to be live at 5 p.m. on Wednesday. We'll see you next time. Take care.